This case is Ciba's acquisition of allied colloids, presented for Dr. Shiroki by Carrie Barkley and Nick Johns. This is a case study of a competitive merger in which the Swiss chemicals company Ciba Specialty Chemicals played the role of a white knight in a bidding war for a British chemical company, Allied Colloids. This case study is intended to highlight a number of interesting and important features of hostile and competitive M&A and related issues. Allied colloids became a takeover target because of their profitability and large market share in a specialized industry. The industry that Allied colloids operates in is specialized chemicals, most notably the production of pollution-controlling chemicals that are used in the treatment of contaminated water. This is what made them a desirable acquisition. Allied colloids also operated in the textile and paper industries, which further increased other corporations' interest to acquire them to diversify their operations. The specialty chemical industry has high barriers to entry. This is proven by the 1.029 billion Swiss francs that Ciba spent to acquire Allied colloids in process research and development. The R&D cost represented a significant part of the acquisition of Allied colloids. The total cost of the acquisition was 3.615 billion Swiss francs, so R&D costs represented 28.5% of that. With such high barriers to entry, it would be much more beneficial for a company to enter the water treatment and specialty chemical industry through a merger or acquisition. Allied colloids also became a takeover target because of poor margins. They had been devalued by the market because of their poor performance related to poor operating margins caused by decreased efficiency. The industry itself, specialty chemical producers in the UK, was experiencing similar problems. The industry was going through a period of cost-cutting, reorganization, and change in policy to increase efficiency. This period of change made the industry as a whole attractive for acquisitions. Allied colloids as a takeover target was the adverse effects of the global market on their sales. Allied colloids sales were directly affected by the strengthening of the pound in 1997. Since Allied colloids operated in the UK, the strengthening of the pound relative to other countries elevated the relative price of their products. This caused customers to either buy elsewhere or reconsider their need for Allied colloid products. On March 12, 1998, Ciba announced the acquisition of Allied colloids for 3.6 billion Swiss francs. Ciba had outbid Hercules of the USA. Ciba valued the gains from the acquisition of Allied colloids in both qualitative and quantitative measures. The most fundamental reason that Ciba had for acquiring Allied colloids was a quantitative increase in future cash flows and delivering value to shareholders. Allied colloids was also an attractive qualitative acquisition for Ciba because of the similarity in business strategy, the intellectual capital, technology, and the ability to expand into a large market in the UK. In this case, the qualities of Allied colloids would directly lead to increases in profitability, market share, and business diversity. Ciba's acquisition of Allied colloids was largely associated with product diversification. By adding Allied colloids' high market share and product line in the highly specialized water treatment industry, Ciba would be able to achieve higher profit margins. The product line would complement Ciba's own specialty chemical portfolio, creating synergies between the two corporations that could not be achieved elsewhere. This includes savings in operating costs of 50 million Swiss francs per year. Another major gain for Ciba was the process of R&D mentioned in question 1. It allowed Ciba to realize gains from Allied colloids simply from the research they had already done. Ciba conquered the barriers to entry of the water treatment industry by acquiring Allied colloids. It allowed Ciba to focus their efforts on refining the operations of Allied colloids instead of starting from the ground up and creating their own water treatment division. Several quantitative approaches were used by Ciba in the evaluation of value gained through the acquisition. The approaches were net present value, earnings per share, economic profit, additional possibilities from expanded capacity usage not reflected, and additional synergistic growth potential. Ciba determined that the NPV of the acquisition would be positive, meaning that it would add value to the firm. Based on the NPV, Ciba's EPS would be diluted in 1998 for one-time cost and small synergies, but appreciate starting in 1999. Economic profit, the difference between revenue received and the opportunity cost of the input, was also determined to be diluted in 1998, but appreciate starting in 1999. The main argument for the positive NPV of the acquisition of Allied Colloids is the decrease in their discount rate, the weighted average cost of capital. The WACC is used as the discount rate for the NPV of the acquisition because the resulting cash flows will be distributed to both shareholders and creditors. Ciba's low debt ratio and good credit rating allowed the company to finance the acquisition with largely borrowed funds. These borrowed funds increased the debt-to-equity ratio of Ciba to their targeted debt-equity ratio, which in turn decreased the WACC due to the tax shield created by the debt and the debt's low interest rate. As with the majority of companies that make acquisitions, the short-term effects were negative for Ciba. In order to see these effects, a comparison of financial statements for 1997 and 1998 is necessary. Ciba's acquisition of Allied Colloids was financed largely through debt, and the final price was 3.615 billion Swiss francs. The biggest indicators of performance for any publicly traded company are the earnings per share and net income. Based on these indicators, Ciba was negatively impacted by the acquisition of Allied Colloids. Ciba experienced a negative EPS in 1998 and a net loss of 791 million Swiss francs. The EPS is calculated by dividing net income by the shares outstanding. The decrease in EPS was caused by a decrease in shareholders' equity. Ciba experienced a decrease in shareholders' equity because of a decrease in retained earnings. The decrease in retained earnings was caused by a one-time write-off to net income of 1.06 billion Swiss francs for purchased in-process research and development, since the acquired technology had not yet been reached fruition and had no alternative use, and one-time charges for the integration of the business. The write-off to net income was the major reason Ciba reported a net loss in 1998. The deal was financed largely with debt, so the number of shares outstanding remained the same, lowering the EPS for Ciba. A positive in the short term for Ciba is the increase in net revenues. Net revenues increased 9% from 1997 to 1998. Earnings before interest, tax, and depreciation and amortization was also increased 8% from 1997 to 1998. However, earnings before interest and taxes, also known as operating income, only increased 3%. Operating income is considered the recurring profit that a business can expect from operations. Although each category increased, the 3% increase in operating profit reflects negatively on the high premium Ciba paid and the 3.615 billion Swiss francs purchase price of Allied Colloids. The debt that Ciba incurred can be seen as both positive and negative. The debt allowed Ciba to obtain their optimal debt-equity ratio, which reduced their WACC. The reduced WACC allowed Ciba to declare that the Allied Colloids acquisition will have a positive net present value. However, the debt is a long-term liability which will require Ciba to pay interest and also subject them to more business risk. It is also unlikely for Ciba to be able to obtain more funds from creditors in the future with such a large amount already on their balance sheet. This decrease in financial flexibility caused Moody's to review Ciba's debt for a possible downgrade. Another negative impact is the negative net cost of goodwill. Goodwill is considered the quantified, intangible value of an asset, in this case, Allied Colloids. The goodwill Ciba gained from the deal was 2.2 billion Swiss francs, but the cost of the acquisition was 3.6 billion Swiss francs, a net negative cost of negative 1.4 billion Swiss francs. The biggest loser in Ciba's acquisition of Allied Colloids is Hercules. Hercules is the U.S. chemical company that started the bidding war for Allied Colloids. Hercules was originally in talks with Allied Colloids, but they could not agree on a price. Hercules wanted Allied Colloids for many of the same reasons that Ciba wanted them. The clear winner in the year-long battle for Allied Colloids is their shareholders. All the Allied Colloids shareholders had to do was sit back and watch as Hercules and Ciba continually increased their bids. By the time the deal was done, Ciba would pay $205 per share, more than double the price per share from the previous November. Allied Colloids employees were not so lucky. They went from winners to losers in Ciba's acquisition of Allied Colloids. Initially, Ciba said that they would keep Allied Colloids' workforce, but by August of 1998, Ciba announced a skills concentration program which would cut over 1,100 jobs. Ciba can be considered both a winner and loser in their acquisition of Allied Colloids. In the short term, Ciba is a loser, as outlined in the previous slides. Ciba could also be considered a winner in the long run. The acquisition of allied colloids allowed Ciba to bypass the barriers to entry in the water treatment market, gain a significant market share of the water treatment market, and avoid the cost and time associated with starting their own division from the ground up. Ciba was also able to reach their optimal debt-to-equity ratio, allowing them to achieve the lower possible weighted average cost of capital. The lower weighted average cost of capital will allow them a wider range of options for possible ventures in the future. In the years after the merger, Ciba seemed to be benefiting from their acquisition. In 1999, Ciba did not exceed the 1998 numbers in terms of net sales, but increased their operating income and net income. Ciba also made an effort to start paying off the long-term debt incurred from the acquisition, which increased their financial flexibility. In 2000, Ciba continued to improve in terms of net sales, operating income, and net income. The increase in those categories led to an increase in earnings per share from 1999 to 2000. However, in 2001, Ciba experienced a contraction because of the harsh global economic environment brought on by the U.S. stock market collapse. Finally, in 2008, after Ciba's stock price underperforming the market, and a second quarter where Ciba reported a major 606 million Swiss francs loss, BASF bought Ciba for 3.4 billion Swiss francs. BASF paid 50 Swiss francs per share, which is a 32% premium over Ciba's share price of 37.87 Swiss francs at the time of the offer. Hercules, the other major player in the bidding war for allied colloids, was purchased in 2008 by Ashland Incorporated. Hercules was bought for $23.01 per share at a 38% premium for a total of $2.6 billion. Ashland Incorporated also assumed $700 million in Hercules debt for a total price of $3.3 billion. Thank you.